You know, most people never realize when their financial life actually goes wrong. There's no explosion, no warning sign, no dramatic collapse. Just one small mistake that quietly compounds, and 5 years later, they're stuck in a life they never wanted. This mistake destroyed more financial futures than any market crash ever did. Benjamin Graham saw this early. Long before social media gurus, before hedge funds became celebrities, before investing turned into entertainment, Graham understood something most people still get wrong today. Investing is not about getting rich. It's about never being forced into bad decisions. That distinction changes everything. Graham watched intelligent people earn good money and still remain powerless. They invested emotionally. They chased returns instead of stability. They depended on income they couldn't control. And slowly, they lost the ability to say no to bad employers, bad investments, bad partners, and bad timing. That's where life starts shrinking. Here's the uncomfortable truth Graham believed. The real danger isn't losing money quickly. It's becoming dependent slowly. When you depend on the next paycheck, you invest desperately. When you depend on one stock, you panic emotionally. When you depend on market hype, you abandon discipline. Graham called this speculation, not because it's risky, but because it removes your margin of safety. Margin of safety wasn't just a financial idea for him. It was a life philosophy. A margin of safety means you can survive being wrong. It means you don't need perfect timing. It means you don't need anyone's permission to wait. Most investors never build that margin. They invest with money they can't afford to leave alone. They tie their self-worth to market performance. They confuse activity with intelligence. Graham did the opposite. He believed wealth should reduce stress, not multiply it. If your investments keep you awake at night, you're doing it wrong, no matter how high the returns look on paper. This is where the biggest mistake appears. People invest to impress. They chase growth to feel smart. They buy stories instead of value. And 5 years later, they're exhausted, anxious, and trapped, managing a financial life that controls them. Graham warned that markets exist to serve you, not instruct you. When you forget that, you hand over control. He invested for one purpose only: independence. Not luxury, not status, not applause. Independence meant never needing to sell at the wrong time. It meant never needing to follow the crowd. It meant never needing to tolerate financial pressure. Graham didn't care if others got richer faster. He cared that he could walk away. That's the rule nobody talks about. Every dollar invested correctly buys you the right to wait. Every bad investment steals that right. This is why Graham preferred boring companies with real earnings, strong balance sheets, and prices below intrinsic value. Not because they were exciting, but because they reduced dependence on luck. Luck is expensive. Discipline is cheap. Most people reverse this. They rely on luck and abandon discipline. They call it confidence. Graham called it ignorance. He once said the investor's chief problem, even his worst enemy, is likely to be himself. Because emotion creates urgency. Urgency destroys patience. And without patience, investing becomes gambling with a long delay. Here's the quiet tragedy. Many people do make money in markets and still lose their freedom. They upgrade their lifestyle faster than their safety. They lock themselves into higher expenses. They turn investing into a performance. Now they must win. They must stay invested. They must stay right. That's not wealth. That's pressure. Graham never invested to prove anything. He invested to remove pressure from his life. He understood that true financial success isn't about how much you make. It's about how little control money has over you. And that's where everything begins to change. Because once money controls your decisions, it stops being a tool and starts becoming a master. Benjamin Graham understood that dependence doesn't arrive suddenly. It creeps in quietly through habits that look harmless at first. Spending a little more because markets are up. taking slightly higher risk because everyone else is doing it, ignoring valuation because prices keep rising. None of this feels dangerous in the moment. In fact, it feels smart. It feels like progress. But Graham warned that when investors stop thinking in terms of safety and start thinking in terms of excitement, they are already in trouble. He watched entire generations confuse intelligence with activity. They traded more, monitored prices constantly, reacted emotionally to headlines, and believed being busy meant being effective. Graham called this noise. He believed the market's job was to tempt you into mistakes by appealing to greed and fear, not to reward your effort. The disciplined investor, in his view, did almost nothing most of the time. This idea is uncomfortable for modern audiences. People want action. They want movement. They want the feeling of control. But Graham argued that real control comes from restraint. The ability to do nothing when nothing should be done is what separates investors from speculators. Speculators depend on the next price movement. Investors depend on underlying value. That difference determines who sleeps peacefully and who lives in constant anxiety. Graham structured his financial life so that time worked for him instead of against him. He invested in assets that didn't require his attention. He avoided leverage because debt removes flexibility. The moment you owe someone else, your timeline is no longer your own. Now you must act, even if the conditions are wrong. Debt forces decisions under pressure. Pressure creates mistakes. This is why Graham was skeptical of anything that promised fast returns. Speed was the enemy of sound judgment. The faster money moved, the more likely emotions would interfere. And once emotion entered the process, independence disappeared. He believed the goal was not to maximize returns in any single year, but to maximize survivability across decades. Most people misunderstand this. They ask, "How much can I make?" Graham asked, "How much can I afford to lose without changing my life?" That question changes how you invest. If a loss forces you to alter your behavior, sell at the wrong time, or accept situations you dislike, then the investment was already too risky, even if it eventually makes money. Graham wanted investments that allowed him to remain psychologically stable. Stability to him was more valuable than brilliance. He trusted systems, not impulses. This is where many intelligent people fail. They overestimate their emotional discipline. They believe knowledge will protect them from fear and greed. Graham knew better. He designed his strategy assuming he would sometimes be wrong, sometimes scared, sometimes tempted. That's why margin of safety mattered so much. It wasn't about pessimism. It was about humility. When you buy with a margin of safety, you don't need to be right about everything. You don't need perfect forecasts. You don't need constant validation. You give yourself room to be human. Without that margin, every decision feels heavy. Every market move feels personal. And slowly, your investments start shaping your personality instead of supporting your life. This is the trap. People think financial freedom comes from earning more. Graham knew it comes from needing less certainty. The less precise your predictions need to be, the freer you become. He saw investors ruin themselves not because they were foolish, but because they were impatient. They couldn't tolerate waiting. They couldn't tolerate underperforming the market temporarily. They couldn't tolerate looking wrong. So they chased momentum. They followed crowds. They abandoned principles the moment they felt uncomfortable. And comfort, ironically, was exactly what Graham was buying with conservative investing. Comfort to think clearly. Comfort to say no. Comfort to walk away. He didn't want to impress anyone. He wanted his future self to have options. This is why Graham separated investing from ego. He never tied his identity to being right. He didn't need the market to agree with him today. He only needed the maths to work over time. Most people do the opposite. They let their portfolios define their self-worth. A red day feels like a personal failure. A green day feels like validation. This emotional roller coaster keeps them dependent on outcomes they can't control. Graham refused to live that way. He treated investing as a defensive activity first, an offensive 1 second. Protect capital, then grow it. Protect independence, then expand choices. When people ignored this order, he knew exactly how the story would end. More money, more stress. Higher income, less freedom. Bigger portfolios, smaller lives. That's the real cost of getting this wrong. And this is where his thinking becomes uncomfortable for people who believe wealth is about lifestyle. Graham believed lifestyle inflation was one of the fastest ways to destroy independence. Every new expense raises the return your portfolio must generate just to keep you stable. Now you're not investing to gain freedom, you're investing to avoid losing comfort. That's dependence disguised as success. Graham deliberately kept his needs modest. Not because he couldn't afford more, but because simplicity gave him leverage. The fewer obligations you have, the fewer people and circumstances can control you. This is the quiet power most people never experience. Money becomes truly useful only when it removes fear. Fear of speaking honestly. Fear of waiting. Fear of walking away. And that kind of fearlessness doesn't come from big wins. It comes from structure, patience, and discipline repeated over many years. That was Graham's real edge. Not intelligence, not secret information, but emotional distance from the market and emotional closeness to reality. He didn't ask what could happen. He asked what would matter if things went wrong. That mindset saved him again and again, and it leads directly to the most important principle people still ignore today, the one that determines whether investing frees you or traps you. Because the moment investing requires constant vigilance, you've already lost the advantage it was supposed to give you. Benjamin Graham believed the final test of any financial strategy was simple. Does this make your life more flexible or more fragile? If your plan collapses the moment conditions change, it was never a plan, it was a hope. And hope is not a strategy. He saw that most people don't fail because markets are cruel. They fail because they build financial lives that demand perfection. Perfect timing, perfect judgment, perfect emotional control. One mistake and everything starts to crack. Graham rejected that approach completely. He assumed uncertainty. He assumed mistakes. He assumed markets would behave irrationally longer than anyone expected. And instead of fighting those realities, he designed his investing around them. That's why his ideas lasted generations. He didn't believe wealth came from predicting the future. He believed it came from preparing for multiple futures and surviving all of them. Survival was the foundation. Everything else was optional. Most people invert this. They design their lives around best-case scenarios. If everything goes right, they'll be fine. If it doesn't, they're trapped. Trapped in jobs they can't leave. Trapped in investments they can't sell. Trapped in lifestyles they can't maintain. Graham saw that trap clearly. He understood that freedom isn't something you declare after hitting a number. It's something you build quietly by refusing to corner yourself, by refusing to let any single employer, client, market, or investment become essential to your survival. That's why diversification mattered to him, not as a mathematical trick, but as psychological protection. When no single outcome determines your future, you gain the confidence to act rationally. Rationality, in Graham's view, was the rarest asset of all. He watched brilliant analysts sabotage themselves because they couldn't stand temporary discomfort. A few months of underperformance felt unbearable. A few years of patience felt like failure. So they abandoned sound principles to chase reassurance. Graham never chased reassurance. He trusted process. And this is where his philosophy becomes uncomfortable for modern investors. His approach is boring. It lacks drama. There's no excitement, no constant feedback, no feeling of winning. But boredom, he believed, was a feature, not a flaw. Boredom meant stability. Stability meant clarity. Clarity meant independence. He didn't want markets to entertain him. He wanted them to fund his freedom quietly. This is why his most successful student, Warren Buffett, later said that investing should be simple but not easy. Simple because the rules are clear. Not easy because following them requires emotional restraint most people never develop. Graham knew this. He knew the hardest part wasn't understanding value. It was waiting for it. Waiting without doubting yourself. Waiting without chasing noise. Waiting without explaining yourself to others, because the crowd will always move faster than discipline, and speed feels convincing. But Graham believed that money made quickly often comes with invisible strings attached. Expectations, obligations, pressure to repeat performance, pressure to stay in motion. Slow money is different. Slow money gives you room. Room to think. Room to say no. Room to walk away. That was the prize he cared about. He didn't measure success by net worth alone. He measured it by how rarely he was forced into decisions he didn't want to make. Every year his investments reduced that number. He considered it a win. Most people never run this calculation. They track returns but not stress. They count income but ignore dependency. They celebrate growth while quietly losing control. Graham warned that if wealth doesn't improve your character and your choices, it's doing its job poorly. And this is where everything comes together. The mistake that ruins lives isn't losing money in a crash. Markets recover. The real mistake is building a financial life that requires constant cooperation from forces you don't control. Employers, markets, trends, opinions, luck. When your survival depends on those things, independence disappears, no matter how wealthy you look on paper. Graham's solution was simple but demanding. Live below your means. Invest with a margin of safety. Demand value, not excitement. Avoid leverage. Be patient. And above all, structure your finances so that time is always on your side. Do that long enough and something remarkable happens. You stop needing to impress. You stop needing to rush. You stop needing to tolerate situations that make your life smaller. Money becomes quiet. Decisions become calmer. Life becomes wider. That's the real reward of intelligent investing. Not the lifestyle. Not the applause. Not the feeling of being right. But the ability to choose your days, your work, and your boundaries without fear. Benjamin Graham didn't just teach people how to invest. He taught them how to protect their independence from the world's constant pressure to rush, conform, and depend. Most people never learn that lesson. Some learn it too late. A few learn it early and quietly build lives they never need to escape from. That's the difference. That's the rule. And that's the reason his ideas still matter today.